Hello, everyone. My name's Marianne from Rural Co-Water, and I am going to present a look at the water market history and also some products for risk management for you today. I wanted to thank Irrigation for inviting us to present to you. It's very appreciated, and I hope you find something beneficial for your business. So what I'm going to cover today is we're going to look at an overview of the above choke markets. As brokers, when we talk about above choke, we mean both Victoria Murray Zone 6 and New South Wales Murray Zone 10. I'm then going to look at some market trends to just get a feel for how things move. Then we're going to talk about some products that you can use to manage the risk that are in the water market, and I'll give you a brief water recovery update. So I wanted to start with a little bit about the above choke markets, explain them. As I said, we talk about Zone 10 and Zone 6 on either side of the river. Those zones are more often than not segregated from the rest of the zones in the southern basin because of the Barmah choke in at the forest. So each year at the start of July, they allow a certain quantity to go through the Barmah choke. This year it was 36 gigs. It's now a ballot, so you can put in a lot. It's like a lottery that people put in for, and they would move. If you win, water is moved down below the choke. The reason to do that is obviously because the below choke price is often reasonably higher and can be extremely higher than the above choke price. Transfers back are always permitted, so back trade. New South Wales to Murray trade. So Victoria to New South Wales is usually open. When the floods were on, New South Wales stopped trade in because of they didn't want to have the storages spilling, but most of the time it's open to trade. New South Wales to Victoria, the other way, has a 200 gig, I'll read this out, has a net annual volume of 200 gigs or the volume that keeps the risk of spill in the Murray system below 50%, whichever is the lesser. The Northern Victorian Resource Manager determines that risk of spill. There's also an exit charge of $7.23 per meg, which is a usage charge for any temp that leaves New South Wales. So I look back at the net trade, and I'd say for 24-25, the net trade was 30 gigs from Victoria into New South Wales. So we do get times where the Vic side is a lower price than New South Wales. I also decided to have a look at the entitlement side-by-side comparison. This table is in order of the highest security entitlement down to the lowest security. So obviously we've got our Zone 10 high, which is the highest security, Vic 6 high, which is sort of moderate and currently is at 53%. Zone 10 general then is the next secure entitlement, and the lowest one is Vic 6 low. Vic 6 low rarely gets allocation. In the floods it does, but it is more used for carryover storage from year to year. So you can see there, Zone 10 general has the highest amount of entitlement and Vic 6 high, the second highest. And the allocations, you can see that level of security. I wanted to go back and also look at the average allocations over the 10 years and within the drought, in particular to compare the Vic 6 high to the Zone 10 general. If I look at the average allocation over 10 years, the Vic 6 high is 97%, Zone 10 general 67%. And then the next two rows are looking at the 4-year, the period of 4-year of the drought, so 17-18 to 2021, where the average price was $232, and the 2-year period, which was 18-19 to 19-20, and the average price there was $434. So these were the highest prices. Now what you can see is the Vic 6 high had a 92% for the 4-year, 83% allocation for the 2-year period. Zone 10 general was only 26% for the 4-year and only 2% average for the 2-year. So I wanted to point this out because people often say to me that the average allocation for Zone 10 general is 67%. So therefore it should be, the price of it should be 67% of the permanent or 60%. But you can actually see that in those periods where we have that extremely high prices, you just don't have the allocation to sell. Now, you probably wouldn't be farming because the prices went up to $500, $600. But if you've got the VIX 6 high, you're going to have some allocation to sell into the market. So this is why we see on the bottom row the permanent price of VIX 6 high is significantly higher than the Zone 10 general, which is currently $17.50. The second bottom row is the carryover capacity. Just want to point out the VIX side carryover capacity is 100% on both high and low, but that is also anything over and above in the new year allocation is put into a spill, what we call a spill account, and you're not able to trade or sell it until the Northern Victorian Resource Manager calls a low risk of spill, which is when the risk of spill in Murray is below 10 or is at 10%. In a dry year, they'll often call it July or August. Wet years, it may not get called and you may actually lose that. It may spill, that spill account. A moderate year, you might be looking at, maybe like this year, maybe November, December, January, where they may call the low risk of spill. So that's just a comparison of the entitlements for you in that above choke market. I'm going to talk about the market trends now in those markets and in permanent and the temporary allocation as well. So this is just the temporary allocation of the last 10 years. Nothing too surprising here. We can see in the drought when the prices were, I think the top was around $6.50, and there was no allocation from, this is Zone 10 general. You can also see how the prices go in line with the allocation. A couple of interesting things to note here. 23-24 was an interesting one because at the start of July, the prices did jump up because we'd had a very low, very high allocation the year before, but people still wanted to buy to lock in for their rice crops. And it was relatively low. I think it went up to sort of 120, 130. But interestingly then, because people had locked in everything for their crops, then we saw, and summer also wasn't, it was sort of still wet around that November, December, we saw the price come crashing off again because there just wasn't that demand. Then, then we go into the autumn period, it turned dry, and at the same time, in about 15th of March, Water New South Wales gives their first outlook for the new year. I think they gave it quite a low outlook, and there was also a high demand in autumn, so then the prices jumped because both the winter crops and also buying for carryover for the new financial year. And we've seen that continually, that price of stay up in that 200 sort of level mark. So, 220, 230, currently to about 240. This chart, I've just got this from my colleagues at Irrigation, and I just wanted to put this up to show the variability in the usage, and in particular the winter cereals, which is the orange bars, and the rice crop, which is the green bars. So you can see they're very variable, and that would be largely based on the price. The top blue bar is cotton. It's not that huge, but it's grown significantly in the last 2 years. There's actually been double the amount of water usage in cotton, so it is growing quite exponentially. The other interesting thing is this year, because the prices have started very high in the 250s, talking to a lot of rice growers, they're not planning to put in a summer crop now. That could possibly mean that we get to that sort of November, December, and the demand And when the allocation in Murray starts to maybe kick, you would see this drop in demand. So it could have the contrarian sort of aspect that it may end up having a lower price in summer when, due to that that drop in demand in the croppings. I decided to also look back at some comparable years where the storage levels were about where they are at the moment for that July period. That the dotted line is the storage as at 27th of August, and they're not exactly the same, but they're kind of close to where they were at that time in 16, 17, 20, 21. Now, the thing I wanted to point out here is that there is a key difference that they both started like we did this year at, I think it was 16, 17 started at 0% and 2021 at 2%. But these 2 years did increase more quickly because the carryover that was in the storage was a lot more in 25, 26. So the carryover that came into this year was 524 gigs. 2021 it was 350, and 16, 17 it was about 168 gigs. Now, what this means is that the storages, as we come into a new year, one not only look at the level of the storage, but how much of that the previous year is being carried over, because that may give you a helpful indication of how much they're going to give out. Because this year was so high in comparison to these years at the same level of storage, we're not getting that new season allocation. So I guess I highlight this so that people maybe use that as that metric and have a look at what the carryover capacity, which you can see in the Talking Water bulletin, so what the customer accounts have as we get towards the end of the year, and that may be able to help you kind of have a little bit better idea of what the New Year's allocation might be. This is a graph on the permanent entitlement markets. The main thing I guess I want to put out here is, again, the VIX6 high in the first year of the drought, when the VIX6 high was getting 100%, and Zone 10 General got, I think, 0. That entitlement had quite a significant jump, and then again the second year in 1920 of the drought. And at the same time, we saw that Zone 10 General come off. I think it went down to about average of 1,400 or so in the drought, and then it's still sort of starting to come back up. The VIX6 high started to drop off when it turned wet. Obviously, the temp prices are a lot lower, so people who are vying for investments didn't want as much of it. At the same time, we had higher interest rates, but now again we're seeing lower interest rates. The temp price is starting to go up, so we're seeing both of these entitlements. Plus, we've also obviously had the government buybacks, so we are starting to see these entitlement prices sort of plateau and turn back upwards again. Now I'm going to talk about what products you might use to manage your risk. So in terms of managing risk for your water for cropping, it's basically based on your own risk return profile. And anything that is less risk is going to cost you more. So, for example, if you purchase everything on forward contracts, which I'll explain in the next slide, you would be paying a lot more for those than you might be for on average on the temp spot market over a long term, because you're getting more certainty. So we have a lot of different risk return profiles of different, and also what the capital required is if you want permanent involved in there too. There is a view by some people that you should have a third, meaning a third of permanent, a third of leases or forwards, and a third temporary, but obviously that all depends on your risk profile. So the forward allocation agreement, this is an agreed volume by a standard contract of the volume, price per megalitre, the delivery date, and the zone. We do in-season agreements. Mostly we do a year ahead, so you would be doing one for next year, but there also can be 2 or 3 year multi-year agreements. Usually the further it goes out, more premium is on the price to take care of the fact that, the price volatility is skewed towards the upside, obviously. So an example might be you buy 1,000 meg forward now for July 2026 at $270 per meg with delivery in July. The allocation risk is on the seller. So the seller must provide this temporary allocation. If they don't have it for some reason at the delivery date, they would have to come to the market and buy it at whatever the temporary price was. The reasons people do this is to avoid seasonal spot market volatility and to know what their budget is for their water for their crops. We do ask for a 20% deposit, which is kept in a trust account until delivery. These forward, so this is just a graph of the different valleys forward allocations. They do go in line with the temporary generally. So you can see back in the drought that they all went much higher and they're coming back again because our temporary price is again higher. They're almost always above spot due to, as I said, locking in that uncertainty and the skewed nature of price volatility in that, at 200, if it turns dry, you can go to 600 where, if it turns wet, you might only have a $100 or $150 move down. It's currently offered around, for next year, we have some around that $275 per meg mark for above choke forward. Carryover or parking capacity, as we call it, is another agreement via standard legal contract to either buy or sell space on somebody else's, your own or someone else's entitlement to carry over for the next season at a particular price. Buyers like this because it's early access to allocation. You get it in July. Vendors like it because they're getting a dollar per meg for something that they may not use, or they may think that they're not going to get as good price in the temporary the next year. So this product can be good for buyers and sellers. Again, the risk is on the seller, meaning if a seller carries overs on their space, they don't get, if the allocation goes to 100%, they wouldn't get that last bit that they've carried over. So if someone's carried over 100, has a 100 meg license and carries over 50 megs for someone, they would only get a maximum of 60 megs allocation in the new year because they carried over for someone else. And they're doing this because they get a revenue from it. The forward price is typically the carryover price plus temp because they effectively come out at give you the same product. The forward price might have a little bit of a premium on it because of the cash flow benefits, meaning people don't have to pay for the 80% of it until the delivery date. And carryover prices basically are the highest when the temp price is the low the year before and we're looking at a potentially drier new year. So if I look back from, I think it was 22 to 23 to 23, 24, we had carryovers in zone 10 at $80 because we came out of a very oversupplied temporary market and the prices were $2. And at the same time, we were sort of coming out of that really wet flooding period. So there was a bit of uncertainty and people were happy to lock in and carry over at 80 if they could keep their water for the new season. Similarly, or not similarly, but also in this past year just gone, we started ones at sort of 75, 70, but it very quickly dropped off because we had so much space available because there was high use in the temporary. And at the same time, the temporary prices jumped to that $200. Less people were willing to take the risk of buying temporary allocation at the end of May, June to carry into this year. So that is an average price that we had for the contracts that we put in place. I think the lowest we went to, maybe we did some at around 40, 45 right at the end of June. So the next product is leases. A lease is, again, an agreed volume of entitlement with a price per megalitre, payment terms and a length. The length of leases are usually longer term, 3 to 5 years. And this, you are leasing the entitlement. So you get all the benefits of the carryover for the entitlement and any other benefits of having that entitlement. It's almost like you own it for that period. So in that case, you are assuming the allocation risk. So we don't do as many of these in Zone 10 General, basically because even if you've got zero allocation, you have to pay, the $90 to $100 meg for the lease. Having said that, you do get the 50% carryover for each year. These are more popular with the permanent plannings where they have to have security of water, so they're much more traded in the below choke area. But we do some, and we also do some that we call hybrids, where there is a lower fixed dollar per megalitre amount, and then an extra dollar per megalitre revenue or payment, depending on what the allocation is. So that's a way for the buyer to transfer some of the risk back to the seller for these products. We do also have done VIC6 low leases. So this is where if you wanted to buy a lease on VIC6 low, which is basically buying a lease for a carryover product. Finally, we're going to talk about, I'm just going to give a quick update on the water recovery. So the first tender, which was for 70 gigs, is now closed. The government has stated they bought 52.3 gigs of that because they didn't buy the whole lot because they only paid for what was value for money. In total, this table shows that the government, along with the EO2, which is a large portfolio expression of interest, as well as other buyback periods, they have bought 103 nominal gigalitres of water across the valleys. You can see up there the Zone 10 General, they've bought 20.8 gigs of nominal, about 14.5 of long-term diversion limit equivalent. They have opened the EOI2, which is the large portfolio of water. They are seeking 100 gigs of that. Many of you would have heard that Duxton did sell some in June 25 at 25 gigs, which would be in those numbers in that table. And finally, the EOI1 responses. This is the one that Murray Irrigation members would have put in for. This is just a progress update on how many responses, etc. they've got. So they've had 79 responses from above the choke. Approximate volume is long-term diversion limit equivalent about 40 gigs. But interestingly, they've stated only 15 to 25 of those are market aligned, meaning that they're value for money. So this would tell me that there is a significant volume that have been put in, much higher prices than the government is willing to pay. From me, so thank you very much for joining us on this Outlook briefing. Thank you.